Assalamu alaikum friends, welcome to part 2 of changes in group structure. Okay, so this is part 2. In part 1 I went through the group structure, what happens when you dispose a subsidiary in the middle of the year, what happens when you do step acquisition. For example, you were having 60% and now you are buying an additional 20%. Hence you are still a subsidiary, you're not losing control. What happens when you're disposing and you're still not losing your control? What happens when you're buying and disposing where you are losing the control? For example, uh, you bought 60% and it was a subsidiary, right? And now you're disposing 20%. So when you're disposing from 60, you're disposing 20%, now you're left with 40%. That means you are no more a subsidiary now. You're losing control. You are an associate. So how to value that, how to record in your group financial statements. All these things was discussed in part 1. Now part 2 and part 3 and part 4, there are 3 more parts which are coming. I will be discussing the questions on changes in group structure. Okay, part 2 will be covering which is this video will be covering on illustrations from your textbook. All the illustrations related to changes in group structure, which is your chapter 19 of your SBR textbook, Kaplan textbook. I'll be doing illustrations, and part 3 I'll be covering all test your understanding, and part 4 will be talking about international subsidiaries and all, right? Foreign currency. We are talking about that in part 4. How to deal with overseas subsidiaries when you're selling and disposing. Okay, because when we translate, we'll be having a gain or a loss. So where we are going to record that related to foreign currency. So let's start with today's video with illustration 1. We are with Tudor, and this is a mid-year accusation of a subsidiary. Okay, this type of questions are very common in your exam. Okay, so just follow through carefully the steps that they are doing, not just in the final answer, but you need to follow the steps to get the maximum marks. So let's start. Okay, on 1st of July 2004, Tudor purchased 1.6 million of the 2 million of equity shares of Windsor for 10.28 million. At the date of the acquisition, the retained earnings of Windsor was 6.15 million. Now, here read carefully, they didn't give you the percentage. Okay, what is the percentage? They have bought the subsidiary. They just give you the number of shares. Sometimes they might not give you the percentage. For example, usually you see that they have bought 50% or 60% or 70% in this entity, in the subsidiary, but here it's different. They don't give. You need to calculate that percentage. Okay, you have to calculate that percentage, and this 10.28 million here, this is the purchase consideration, and also they have given the return earnings of the subsidiary, and you will be given the statement of profit and loss where you will be having the parent company as well as the subsidiaries information. Okay, and now we have some information relating to this. So we don't have a statement of financial position. This is relating to prepare a consolidated statement of profit or loss. Usually in your SBR exam, you will not be asked to prepare a full consolidated statement of profit or loss. They will give you extracts to prepare, right? But this is a good question to start with, because this gives you a foundation, a basic, how to deal with more complex issues and all related to statement of profit or loss. This is the easiest question you will find in your textbook. Okay. And from revision kit perspective, I have completed all the group accounting questions on revision kit. So you can go and check. It was question 1 to 16 was for doing group accounting. So it's done. It's there. You can go and check in the playlist SBR revision kit solutions. Question number 1 to 16. So let's start the other information. So before you even calculate, what are the things which you need to know basically? Statement of profit and loss. If you see your profit and loss account, revenue, right? Cost of sales. You cannot just take the subsidiary's revenue as it is. You might have to make some adjustments in the subsidiary revenue, or adjustments could be for in your expenses. It could be in your definitely there will be an adjustment required here, return earnings. Okay, and because it's a subsidiary, okay, we need the fair value, we need the NCI is very important. NCI is profit, okay, which comes before this profit for the year. After this, there's a line which talks that the profit that will go to the parent and the profit that will go to the NCI. So for that, you need to calculate NCI. Okay, so what are the things you need to calculate usually? Goodwill, NCI, net assets you have to calculate. So let's start. There were no items of other comprehensive income. Okay, so there are 3, 4, 5. These are the 5 points. Okay, and the question most of the students ask from me, ma'am, how do I solve when other information is there? There are so many information. Should I solve one by one? The question is no. You have to read all, and then you have to deal accordingly, step by step. It's not that you are reading only one information and then you are starting doing calculations. No, you have to read all the following information and highlight the keywords, highlight the important words. So first one is the fair value of net assets at the date of acquisition were equal to the carrying value with the exception of plant and equipment, which had a carrying value. So this is relating to plant equipment carrying value but had a fair value of 5.2 million. Remember guys, in your question you will get at least one, okay, in the net assets only one asset with a carrying amount, which carrying value which is different to fair value. Okay, the reason is this thing is there because you have to adjust your net asset. That's why you adjust your net asset. Otherwise, you could take the net asset as the carrying value. So one asset will be there that you need to change, and on that you have to calculate depreciation. So because of this, your net asset changes. Okay. So the remaining useful life of this plant was 4 years at the date of the acquisition. Depreciation starts to cost of sales. You see your cost of sales will be now affected because of this depreciation. It is there. And it is time apportioned on a monthly basis. Because this is a midway acquisition, right? It was not a subsidiary for the whole year. So in your profit and loss account, you have to time apportion. When you're taking sales of the subsidiary, cost of sales, expenses, income. Coming to point number 2. During the post-acquisition period, Tudor sold goods to, this is another common area. Subsidiary, parent, selling goods to each other. Intra-group sales. You should know how to deal with this, okay? For 12 million. But you should know who is selling to whom. Is it the parent or is it the subsidiary? So in this case, it is the Tudor. That means the parent is selling. Parent will be realizing the profit, okay? Selling goods to Mr. for 12. The goods had originally cost 9 million. During the remaining months of the year, Mr. sold 10 million at cost to. This time, this is Winston. The subsidiary is selling to the parent, okay? Of this goods to third party. Sorry, this 10 million was sold to third parties, okay? This is not an intra-group sale. This you have to take as a revenue for 13 million. But you have to time apportion again. Income and expenses acquired evenly throughout the year. Third point does not have so much of impact. Coming to fourth. Tudor has a policy. You will be given the policy of valuing your goodwill or NCI, whatever it is. Because sometimes they might tell you that the policy of measuring NCI is fair value, or sometimes they might use this word, okay? Full goodwill method or fair value of NCI is the same thing. So if it's full goodwill method, they will give you the fair value of NCI, which is in this case 2,520,000. And fifth one is the recoverable amount of the net assets of Winston at the reporting date was this. This is the recoverable amount. What does it mean? What does it mean? Impairment. There's an impairment that happened. Okay? Of net assets. Any goodwill impairment should be charged to admin. So any goodwill, if it's there, okay, should be charged to admin expenses. Usually, when they say any goodwill should be impaired to admin expenses, it could be, there might be or there might not be. But usually when they give, what I have seen is that there are goodwill impairment. There are goodwill impairment. Okay, and that should be recorded in admin expenses. So for that, even though goodwill we are not recording in the statement of profit and loss, we are writing in the statement of financial position, but goodwill impairment we need to record it in the statement of profit and loss. For that reason, we have to calculate goodwill also. no matter what you're preparing. Okay, so now you prepare the consolidated statement of profit and loss. Before you jump to the final answer, you have to do workings. Okay, and this working has to be in steps, numbered, labeled clearly. Okay, so how do you start? If you see, I will show you this thing. This is the main table, the main answer. Main answer comes first and your working comes later. So for that I'm keeping some space. Now I'm going to the working. Okay, your working one should be the group structure. Okay, label it, working one, group structure. You have to label for each working what you are calculating. So this is group structure. This is the easiest. Okay, that means how much he owns, because you are not given directly. Here he says he owns 80%, but this 80% was not given anywhere in your question. So how did he calculate it? Let us go back. If you see here at the beginning, in the first line, they say they purchased 1.6 million out of 2 million. So it's easy, just find the ratio. 1.6 out of 2 million. The percentage is 80, 0.8. So that's 80%. Right? This is how you have to find how much they have purchased out of the total equity. You will get your percentage. Because you have to find in terms of percentage. Okay? So 80%. And the acquisition took place 3 months into the year. Okay, let us look. Year end was 31st March 2005. Okay, and he purchased on 1st of July 2004. So July, August, September, October, November, December, January, Feb and March, 9 months. Okay, so it was not for the whole year, 9 months only. So 9 months is post acquisition. That means after acquisition 9 months, and before acquisition it was 3 months. So for 3 months he was not a subsidiary. You cannot consolidate for 3 months. You only can consolidate for the 9 months. This 9 months you have to apportion for everything, all the items in your statement of profit and loss. Whether it is sales, whether it is income, whether it is expense. Okay. Now we are coming to the second. Second working is your goodwill impairment. Usually when we calculate for a statement of financial position, we do net asset. But here we don't need it as working number 2. Okay, because net asset of the subsidiary has been given. Okay, the reason why, I'm sorry, they have calculated it, but they have calculated it as working 3. Usually working 2 is calculated as net asset in the statement of financial position. Normally when you say group accounting, but in this case it is goodwill impairment. Okay, the reason is because that net asset will not go in your statement of profit and loss, right? It is the impairment that will go. That's the reason maybe they have calculated working number 2. But if you calculate this as working 2 or that as working 3, it does not matter. You can take it in any way. Okay. Any order. Goodwill can come first or the NC, net asset can come first. That order can be changed, but let's follow this order. Net assets of the subsidiary, working 3, they have calculated. You need the net asset first. Okay. This is goodwill impairment. So you need the net asset. That means the carrying amount minus the recoverable amount. The recoverable amount is already given. 14.150, but net asset we have to calculate. So for net asset you have to add goodwill also. Goodwill with net asset will give you the carrying amount of the asset, right? So for net asset 13,000 we have to go to working number 3. You need to calculate net asset and you have to calculate like this: acquisition date and other reporting date. You have to make this 2 column. Follow this pro forma even in your exam to find the, and you start with equity capital. So equity capital you always take the same. Okay, whatever is given in the statement of financial position, you take that one. But here they have not provided you with the statement of financial position, but they told it's 2 million. Okay, they have told in the beginning. Usually they will give a statement of financial position also is given. So from there you can take this one. But here they have given that 2 million. Okay, they have purchased 1.6 out of 2 million. 2 million of Winster. So it is 2 million. Okay, and this remains same at the acquisition date and at the reporting date. Coming to the retained earnings. Retained earnings was this It's given in the beginning, right? Again, it's given here. This one, 6.15 million. Okay. But you need to do some adjustments to retained earnings. Okay. So what was that adjustment at the reporting date when you have to find out? It is this. 5.4 million brought forward plus 3 million. Okay. At the reporting date means in the statement of the financial position. So if you, and where did you get this 5.4 million? Just this one. This one you have to take 5.4 million. Okay. This is the reporting date for Winster only you have to take, and you have to add this profit for the year. Don't forget that. So at the reporting date, it is profit plus the retained earnings. That will go as your retained earnings. Hence 8 million, 8.4 million. Now we are coming to the fair value adjustments. Don't forget the fair value adjustment. Right? And this depreciation you have to calculate after you calculate the fair value adjustment. Okay. For that we have a separate working number 6. So fair value adjustment is 5.2 minus 2 million. This is only for PPE, right? It was given here that the value, let me highlight it. The value was this, fair value was this, but the carrying amounts too. So the difference is the increase in the fair value, which we have to take. And depreciation working 6. So let us now go to working 6 for depreciation. Okay, access depreciation, you need to write like this. So if you see, we just have to divide it by 4 years. Okay, that's 3.2 million only. That access you have to take, not 5.2, not 2 million, not 5.2. This you have to take over 4 million, the excess. So divide by 4 depreciation, and remember depreciation and fair value adjustment will be 3.2 for both. Okay, that does not change. And depreciation you never take at the acquisition date. Depreciation only at the reporting date you have to take. 600,000 is always like that, because depreciation normally is calculated after a year has passed, which is at the reporting date. It's never on the acquisition date you calculate depreciation. Okay, hence you have this and this. So the difference is you have to write. So the net asset, which net asset you have to take? This you have to take. You have to take the net asset at the reporting date, 13 million. Okay, for the goodwill impairment. So 13 plus goodwill. Goodwill we have to calculate it, and it's in working 4. So let us go to working 4. So this is the pro forma of goodwill calculation. We all know that consideration plus fair value of NCI minus fair value of net asset at acquisition. But so consideration is given that they have bought it for 10.28 million. Fair value of NCA was also given. Net asset we just calculated, but this is at acquisition. This net asset you have to take, not at the reporting date. Goodwill, when we are calculating it, you have to take at the acquisition only. And hence, when you are taking it, okay, it is this 1450. So this 1450 is taken in working number 2 for the goodwill impairment. Hence it is this. Okay, this 1450 which is taken, and then recoverable amount is given. So the difference, so the carrying amount is more than the recoverable amount, hence there's an impairment of 300. Okay, and remember, impairment you have to decide how much it will go for the NCA and how much of it will go for the group, the parent. Why? Fair value method. We have used a full goodwill method, the fair value method of NCA. So this needs to be factored in when calculating the profit which is attributable to the NCI, working 7. You have to take that impairment. Now, so net asset is done, goodwill is also done. These are very common workings, okay, in your group accounting: net asset, goodwill, NCI, excess depreciation, profit which goes to NCI, then PURB, provision for unrealized profit. We had an intra-group sale that we need to take here. Okay. So we'll go in the notes for that. So here, the parent sold to subsidiary for 12 million. Okay. And during the remaining month of the year, visitor sold 10 million at cost of this goes to third party. Okay, so out of this 12 million, he sold 10 million to the third party. So how much is remaining in the inventory? 2 million. And he sold it for 13 million. So you need to have to find the profit. 2 million. Okay. 2 million is remaining in the inventory. It is an intra-group sale. Okay, out of that 12 million, 10 million he has sold outside. So the total that is remaining in the inventory is 2 million. Okay, what about the profit? You need to find the profit also. That remains in the inventory is, so the intra-group sale is 12 and the cost is 9. Okay, and it is into 2 over 12. You have to check the month. Okay, whenever you are taking the profit, you have to allocate it, time apportion it. So here, during the post-acquisition, they sold goods and the cost. So here they didn't give you the time period, but it's supposed to be for 3 months. I'm wondering why they're taking it for 2 months, right? So here the profit remains in the inventory is 500,000. Okay, 2 over 12. Okay, this is the profit they're finding out. Okay, this is not the month they are taking 2 over 12. Because when you're taking in the statement of statement of profit and loss, you will anyway time apportion it and take. Okay, you will eliminate this on consolidation. So this 2 over 12 is the proportion of the profit. That is, the profit is only 2. Okay, out of 12. So that is the ratio they are finding, 2 over 12. And hence, this is the inventory that remains. Usually they give you a profit margin or markup or something, but here they didn't give anything like that. Okay. So they have the profit of 2 and they sold it for 12. So 2 over 12. So this 500,000 you need to take here. Now we are going to the excess depreciation. This was done. Profit that goes to NCI only. So for this you have to find for the subsidiary's profit. What is it? You only have to take for the 9 months because he was a subsidiary for the 9 months. 3 million. What is this 3 million? In your statement of profit and loss, the profit for the year that goes to investor. Okay, we are not taking the retained earnings, only the 3 million. In the statement of profit and loss is given as 3 million. That profit we are taking only 9 months because we have taken 3 million, which is for the whole year, which is not correct. You only have to take for the 9 months. Now, excess depreciation and goodwill impairment. Whatever the expenses, you have to deduct it from the profit. Okay, that is excess depreciation and goodwill impairment. Not all expenses, not all the expenses that is given in your statement of profit and loss. Only those expenses that has been affected because of this, because of buying subsidiary, because of this consolidation process. What is this? One is excess depreciation because there is some increase in fair value of property, plant and equipment. The other one is goodwill impairment because you are buying the subsidiary, so there will be a goodwill, and because of that there's an impairment also. So only these 2 expenses. So excess depreciation we have already calculated 600. Goodwill impairment 300. Okay. Goodwill impairment, we have done it in working to. From there you can just take the figure here, and when you are taking it, NCA is 20%, okay, because we have bought 80%. So you have to take 20% of this, and that profit will go to the NCI, and this you have to record in the statement of profit and loss. Okay, so we are done with all the workings. Now we can go to the answer. So when you are going to the answer, I will just show you for the first line. When you are taking the revenue, you can take this and you can take this, but for the 9 months. Okay, revenue 16 and 24. Just see here, they have apportioned it for 9 months only. The parents one you can take as it is full, and minus 12,000. What is this 12,000? Intergroup sales. They have sold it for 12 million, right? That 12 million you have to deduct to the subsidiary. Cost of sale is also like that. You take the parent and you take 9 months minus 12,000. This 12,000 you have to deduct from here as well. Okay, and plus 600. What is the 600? Your depreciation. It is your depreciation because they told depreciation is under cost of sales. So you have to add that depreciation. It's an additional expense. And plus 500. What is this 500? That is the cost of sales for the intragroup sales. So that you have to add. Okay. And then gross profit you will be taking after taking this to. Gross profit you are not adding this to. Okay. When you are taking gross profit, don't add this to 18 plus 4,000. It is after you deduct the sold. So you will be having one gross profit. And hereafter, rest all are easy. You just have to take the parents and take 9 months of the subsidiaries. But in the admin expenses, there's 300 that has to be added. What is this admin expenses? What is this 300? Goodwill impairment. It is goodwill impairment because they told goodwill impairment will go under admin expenses. Okay. And now we are coming to the profit from operation. Nil means subsidiary does not have an investment income. So you can take the parent. And here they don't have, here you only have to take the subsidiaries. Okay, the rest all is easy. Tax also you have to take 9 months of subsidiary and the parent. So after you reach here, okay, the new change comes in this section. That is profit that will go to the owners of the parent as well as the NCI. For the NCI, we have already done working 7. There is no working for parent, okay, this is just a balancing figure. That means first you have to write for the NCI, then parent automatically you will get. So this profit, you have to get this profit only. Out of this 9925, how much of it goes to NCI, how much of it goes to the parent? NCI it is 270, we calculated in working 7. So the balance is for the parent. And hence this and this needs to balance always. There are no other items of other comprehensive income, but if other comprehensive income is given, that also you have to do same like this for the profit. You have to apportion between the owner and the NCI. Okay. So that this is only for the statement of profit and loss. This is how you prepare a statement of profit and loss. Okay, consolidate a statement of profit and loss. Now let us go to the second illustration. So I can go a little bit faster now because first question I went slow. I was giving you time to observe. It was like I was setting the foundation for you. Now we can follow through. So illustration 2. Before that, always read the requirements first. Prepare the consolidated statement of profit and loss for the I group for this one. So this is also consolidated statement of profit and loss, and calculate the goodwill also arising on the accusation. So here you see the nature here, they have clearly given you the percentage that he has owned 90%. Okay, so he has owned 90% of the ordinary shares for many years, and I also has a 10% investment in the shares of Bryony. Okay, this 10% is a different investment and this 90% is a different investment. Okay, this is a subsidiary and this 10% is what? It is 10%. It's not a subsidiary, it's not an associate also because it's less than 20%. So what is it? It is a financial asset. Yes, it is dealt under IFRS 9. And this, because it's an IFRS 9, they will tell you it is measured through fair value through profit and loss or fair value through OCI. This is fair value through profit and loss. Okay, and it is held at this date as 24,000 in accordance with IFRS 9. Even if they don't write IFRS 9, it is understood that it is IFRS 9 only that you have to use. On 30th June 2007, okay, I acquired a further 50% of Brian's equity share at a cost of this one. So he acquired further. This is step acquisition, okay? At a cost of, this is the purchase consideration. Earlier he was having 10%, now he bought another 50%. So he was not a subsidiary that time when first time he bought, but now he became a subsidiary after that 50%, because 10 plus 50, 60%. So here are given the statement of profit and loss for three components. One is a subsidiary for the whole year, okay? This is 90%. So you can write S. This is for the whole year, so there is no issue with it. But for the third one, this one is 10% plus 50%. Okay, so you can write like this. The NCI is calculated. NCI is calculated at fair value, same like the previous one. Net asset is given, NCI is given, original 10 investment. So you will be given the amount for the 10% investment also. What is the amount? What is the value at that date? You need this. So now, let's go to the working. So working number one, I told you, start with the group structure. So this time it's two company. So this one, it is 90% subsidiary. This one is not. For 6 months, financial asset, that means you have to use IFRS 9. And for the other, the last 6 months, he is a subsidiary. So you consolidate for 6 months only. 10 plus 50, hence 60%. Okay, so this is step acquisition. This is known as step acquisition. You are buying the subsidiary in installment. First 10%, then 50%. Not in one go like this, 90%. This is not a step acquisition. But the second one is a step acquisition. Okay. So that's why when you are taking for the step acquisition, the previous investment in shares has to be valued at fair value. That means that 10%. What is the amount value for that investment when it was 10%? You have to revalue it at fair value, because they have given you the cost only. So when you are revaluing it to the fair value, the gain will go on the gain on revaluation will be recorded in the profit and loss, that gain on revaluation. Okay, so how much is that gain? This you can write in the group structure only. There's no separate working for that. Okay, so here they have given you that this is the fair value 26 of the 10% investment, but in the beginning they told it is 24, so it increased by 2 million, so that's the profit. Okay, so you debit investment and you credit profit and loss. It's a income, it's a gain. So now when you're writing the investment, it will be held at 26 million only, the fair value, not 24. And you need this because it is included in the calculation of goodwill. It's an investment, so investment means it is recorded as a non-current asset. That's why we need it in the calculation of goodwill. Why? For net asset. When you're calculating net asset, remember this is included there. We need net asset for the calculation of goodwill, so this investment is included there when we are calculating goodwill. But usually we write it as a separate, okay? We don't write it together. We write a separate line for it. You will see when we go there, when we calculate goodwill. So we know that he has a control over 6 months only. So you consolidate for 6 months, all the income and the expenses. So now, profit that is attributable to the NCI. Same like previous one, which profit will go? So you can take 120 for the fluid as it is. Okay, remember when you are taking NCI, there are two subsidiaries here. One is Fleer and the one is this one. So his one you can take as it is, 120. Just check. Again, we'll just so if you see this 120, you can take as it is. But when you're taking the 16, you have to apportion it. You only have to take for the 6 months. Okay, 16. Hence, this 16 is 8 because you are taking 6 months only. Okay, and then you have to take into 40% because don't take when it was at 10%. You have bought 10 plus 50, so it became 60%, so NCA is 40%. Okay, so here it will be 12 because you are taking into 10% because it was a 90%. Okay, so for NCA it's 10%, but for this one it is 40%. Hence 3.2. So you add this 12 and this becomes a profit that goes to NCI. Okay. So if you see, that's what you need. Okay, you don't need any other thing. And they asked you for goodwill calculation separately. So there's a separate calculation. This does not come under the working because they have told in the requirement and calculate goodwill. So whenever they ask under the requirement, it does not come as a working. You write it as a main answer. That's why this is about the working. This is also an answer after your statement of profit and loss. So how do you start goodwill? Fair value of previously held interest like this. It is 26 million, right? The fair value of the 10% investment. Then consideration. Which consideration? For additional interest. Remember, when you bought 10%, you don't care at what amount you bought this 10% because you were not a subsidiary. But what about that 50%? You have to check at what price you bought that 50%. That is 160. That is this one. Sorry. This 160. He bought this 50% at 160. Okay. You need that because at that time only he is having the control. So you are taking that for additional interest. Okay. NCI at accusation is already given fair value and fair value of net asset is also given 200 at accusation. It is given here. If you see, that's the reason we skipped many of the workings. Net assets we didn't have to calculate, and unrealized profit nothing was there in this question, so we didn't have to calculate all those things. There is no fair value movement and also depreciation, all those things. That table for net asset we didn't have to calculate here. All those working we skipped, and hence the goodwill is 86. Okay, so there is no impairment for goodwill, nothing like that. Just goodwill is this working. This is separate. Okay, for this you will be getting separate marks. So now let us go to this. This you can take, this is the parent. This is the first subsidiary. That also you can take in full. Only for the second subsidiary you only have to take for the 6 months. Okay. So there are no such adjustments, just take parents for subsidiary and 6 months for the second subsidiary. Everything is like that until you come here. Profit on derecognition of equity investment. Remember when you revalued that equity investment of 10% to the fair value, there was a gain. That gain is 2 million. That gain we have to take here. Okay, and rest all remains the same. After this profit, you have to divide this among the equity holders and the NCA. NCA we calculated 15.2 already. So the balance goes to equity holders. Okay, now let us go to illustration 3. Rock. Okay, let us see the requirements. Calculate the profit and loss on disposal in the individual financial statements as well as in the consolidated financial statement. This is another important area, guys, that you have to know. You should know the impact, even though the examiner does not ask, but they ask sometimes, right? Not always, but individual financial statement they sometimes ask. What is the impact in the individual versus the consolidated? So in that case, you should know both the impact in both the places, not just the consolidated financial statements. Okay, so calculate the profit or loss on disposal in both these things. Okay, this is not a full consolidation process. This is just they want for the disposal part. Okay, the profit and loss. Rock has held a 70% investment in Dog for 2 years. Goodwill has been calculated using full goodwill method and there has been no goodwill impairment. Rock disposes of all his shares in Dogs. You see, disposes of all his shares. This is a 100% disposal. That means from 70 he is becoming 0. So these are the information. Cost of the investment, fair value of net assets, fair value of NCI, sale proceeds, net assets at disposal. So how are you going to calculate the profit and loss on disposal for this situation where there's a disposal? So in the individual financial statements, it's very easy. At what amount you are selling? What is the cost of the share that is sold? Find the profit. 3 minus 2. Okay, because you bought this for 3 million. Sorry, you sold it for 3 million and the cost of investment was 2 million. So it's easy in the individual financial statements. But coming to the consolidated financial statements, you need to follow this pro forma. Learn this pro forma. Because this is also an area which is frequently asked. But for that we need 2 workings. One is for goodwill. The other one is the NCI at the disposal date. So start with the sale proceed. Here also it is 3 million only. Okay, sorry, 3,000. And net assets at disposal. So when you are interest in subsidiary that is disposed of, right? You have to deduct because there is no net assets when you're disposing. So you have to deduct it. There is no goodwill also. That also will be deducted. And the carrying amount of the NCI will be deducted from this too. And then this will be deducted from this. And you finally find the profit. So what is the net asset at disposal? Because there will be no net asset anymore after disposing, 2.4 or 2,400. Then what is the fair value of net assets at acquisition? Keep it, okay, 1.9. We don't need it now. We need at the date of the disposal. Net assets also at the date of disposal. Goodwill also at the date of disposal. Don't take the acquisition net asset, acquisition goodwill and all. So goodwill at disposal you need to find out. Okay, you bought it for 2. Fair value of NCI at acquisition was 800. And net asset at acquisition. Now you needed this net asset at acquisition for finding goodwill. So 900 is the goodwill. Okay. Carrying amount of the NCI at disposal, 950. So NCI at acquisition is 800. Okay. It's given. And because it's a 70%, so NCI is 30%, you have to take the post acquisition, the NCI as percentage. So post acquisition is 2,400 minus 1,900. How do you get that? At the date of disposal minus at the date of acquisition. The net asset, the moment in the net asset. Okay. On that you have to take 30% and add with the net NCI at acquisition. So this is 950. So this is 950 you deduct. Okay. From this too. And so make a 2 column like this. This should be in the inner column. Net assets, goodwill and NCI. In the outer column sale proceed and the total of this will go in the outer column. Like this, and finally you will be getting the profit. If you see the profit in the consolidated versus the individual is totally different. In the individual is 1,000 and on the consolidation it is 650. Okay, that's the reason you have to know the impact in both the places is different, it's not the same. Now let us go to illustration 4. Okay, so illustration 4, requirement: discuss the above accounting treatment of the above in the consolidated financial statement. This is a very common type of question that is asked. Usually you are asked this type of questions only. So don't only focus on calculation. You also have to know how to discuss also. Okay, discussing part is important. You have to know the discussion as well as the calculation. It has to be balanced. Sometimes when you calculate, you need to discuss that. So Thomas disposed of 25% on 30th June 2006 for 125,000. It was a 70% holding. That means 70 minus 25, it becomes 55. 55 or 45? 45, right? 45. That means he is no more a subsidiary after disposing 25%. He becomes an associate. It has been acquired for 5 years before this. Thomas uses full goodwill method and goodwill was impaired. Okay. Net asset at disposal date, fair value of the 45% holding. And carrying amount of NCI was given at the disposal date. So you need to discuss this. You don't have to calculate. But you have to calculate when to support your answer sometimes. Okay. Like this. Here. You have to find out this profit, right? On disposal. For that you have to calculate. Even though they didn't ask you to calculate here, you see they told discuss the accounting treatment. Still you have to calculate. Because you need, it's like the calculation is supporting your answer to discuss. Okay. Because if you don't find that profit, how will you write the impact of that profit? That this is the profit that you have to record. That's why you have to find this profit. So first, how are you going to write? Write the change in the group's holding. So the group's holding in percent has reduced from 70 to 45%. That means what's important is when you're disposing whether the control is lost or not. So the control has been lost in this case because less than 50%. So because the control is lost, then you have to calculate a profit and loss on disposal. This must be calculated. If it was not, let's say it was from 70 to 60, then you don't have to calculate this profit and loss. Then that's not a loss in control. Then that's a increase in NCI. That increase in NCI you have to find out. We'll go through that situation also, but let's go through this where the control is lost. Because in the exam you can be asked any one of it. Either the control is lost, either the control is not lost. So you have to be prepared for both. So now you start with the proceed. You are selling it off for 125,000. Okay, 125,000. And then fair value of retained interest is 245. Whatever is retained, you have to add. Learn this pro forma. This is a pro forma only. When the values control is lost, how to find the profit and loss. Okay, so with that proceed, you have to add the fair value of the retained interest, which is this. And then net assets at disposal 340, NCA at disposal 80, there is no goodwill at disposal. Okay, they have not given you any goodwill. So don't write it. And then you deduct it. NCA you have to deduct always. Okay, make this 2 column always. Don't write everything in the 1 column, outside column, make 2 column. This comes inside, that comes outside. And finally the profit on disposal. Now you have to write more. It's not the end. You have to write about that 40% shareholding. What is it? It will normally give the investors significant influence. This is the key word for the associates, a significant influence. So that means it meets the definition of an associate. So because of this, from this date onwards, this investment will be accounted using the equity method in the consolidated financial statements. Because when it's an associate, you have to use equity method. You have to write this in your answer. Okay. And also you have to write this also, that on 30th June, remaining investment will be at a fair value of 245,000. Now let us go to illustration 5. No loss of control. So here, no loss of control. Until 30th September 2007, Juno held 90% of Hera. On that date, it sold her 10% interest. So from 90 to 10, it's still a subsidiary, 80% only for 15,000. At the date of the share disposal, the carrying amount of the net assets and goodwill were 120. At acquisition, NCA was valued at fair value. Okay. Discuss the above treatment. This is no loss of control, but you have to find the increase in NCI because you disposed. So this decrease from 90 to 80, he still exercises control. Therefore, it's a subsidiary. Because of that, this transaction is no gain or loss. Okay? No gain or loss is recognized. Goodwill is not recalculated when you are disposing, no goodwill, because after disposing also subsidiary. But this transaction is accounted for in equity as an increase in NCI, because when you are disposing, NCI will increase. Okay, so you are disposing it for how much? you debit the 15,000 because I was saving it. What is the increase in NCI? This you have to credit. That means you have to deduct that increase in NCI. So NCI is 10%. How 10%? You were having 90%. Okay. At 90% it was 10. Now you are having 80%. Now NCI becomes 20%. So from 10 to 20, that increase you have to find out, okay? Not this 10%, not this 20%, that increase only, that change. So this 10% into 100 plus 220. This 100 is net asset, this is goodwill. Okay? That is the net asset and the goodwill at the date of the disposal when you are taking it. There is no NCI there, okay? So there is no NCI, and they told that it's a fair value. So fair value of NCI is not given to you. So when it's not given to you, this is the way to take 10% of this net asset plus the goodwill, okay, for NCI, and you deduct it. And this is a positive figure, so it's a gain. Sorry, it's a credit in the equity. It's a balancing figure, okay? Increase in other components of equity. You don't take it as a gain also. So now you are writing it. This is just a calculation you are doing, but you have to write it also. Then NCI, this is an increase by 12,000, okay? And this 3,000 will be recognized in the equity attributable to the owners of the Juno. That's it. And finally, the last illustration, illustration number 6. IFRS 5. Okay, just let me. Yes, I'm over. Illustration 6. IFRS 5. Subsidiary held for sale. It could be like that also, which means the definition of IFRS 5. Let us go through this. David acquires Rose on 1st of March 2007. Rose is a holding entity with two wholly owned subsidiaries, Mickey and Jackie. Jackie is acquired exclusively with a view to resale and meets the criteria for classification as held for sale. David's 1 year end is 30th September. Okay. On 1st of March, the following information is relevant. They have given the liabilities of Jackie at the fair value, acquired assets of Jackie at the fair value, expected cost of selling Jackie 5 million. On 30th September 2007, that is March, April, May, June, July, August, September, 7 months. The assets of Jackie had a fair value of 170. And the liabilities had a fair value of 35. Okay. The selling costs remain at 5 million only. So asset and liability changed. Discuss how Jackie will be treated in the David's Group financial statements on accusation. So, on accusation, the assets and liabilities of Jackie are measured at fair value less cost to sell in accordance with IFRS 5. Because if it misses the definition of IFRS 5, how should you record it? Assets and liabilities? Fair value less cost to sell. There is no value in use given to you because visually we see. I'm sorry, I got confused with the two standards. Value in use and fair value less cost to sell comes in your this one for the impairment for finding the recoverable amount. I'm sorry, I just got confused with the two standard. Okay, it is IFRS 5. So IFRS 5 you measure it fair value less cost to sell. See, don't make this mistake. It can happen to anyone. Okay. When you are especially reading this line fair value less cost to sell, you get confused that value in use and all. So don't make the mistake. Asset less selling cost. Asset is 185 and liability is 40 less fair value cost to sell. So when you are taking the asset 180, you are taking this 180. Okay. And when you are taking the liability, you are taking this liability 40 and selling cost is 5 only. But at the reporting date, asset and liabilities, you have to change it. because asset now became 170, this remained same 5, and liabilities became 35 instead of 40. So here it is 130. If you see from beginning it was 135 and here it's now 130. It fell down by 5, right? So it decreased from 135 to 130. How are you going to deal with this decrease? So this 5 million reduction in fair value must be presented in the statement of profit and loss as a single item. The important word is this: it will be under discontinued operation. Okay, because it meets the definition of classification for sale under IFRS 5, so it will be entitled under discontinued operation. Also included in this line is the post-tax profit or loss earned or incurred by Jackie in the March-September 2007 profit. In this discontinued operation, not only that fair value change, but also whatever the profit and loss earned, right? From the March to September 2007, for that 7 months is also included in that discontinued operation. So when it's IFRS 5, okay, when you're selling it, remember the assets and liabilities of Jackie, because you're selling Jackie off, right? This must be disclosed separately on the statement of financial position. You cannot add it with the other subsidiaries assets and liabilities. You cannot consolidate. You have to show it separately because they are disposing. Discontinued operation, right? It is under IFRS 5. So Jackie's assets will appear below the subtotal for the Davis Group current asset. You have to write like this. For that you have to know also which comes up, which is below what. Even though you don't have to prepare that full account, but you have to know to write in sentences. Below the subtotal for the group's current assets. So first you write the David Group's the current assets. Below that you write Jackie's asset. Okay. So non-current assets classified as held for sale will be 165. How it is 165? On 30. Okay, wait, just. And his liabilities will appear below the subtotal of the current liability. Okay, and liabilities directly associated with non-current assets classified as, and no other disclosures are required. Okay, this is 35. This is a liability if you see. Liabilities, it will be this liability. You have to take the fair value. This liability 35, not the 40. And when you are taking asset, it is this 165 asset, the fair value 170 minus 5. So this will go like this. You have to write like this: non-current assets classified as held for sale, and liabilities associated with non-current assets classified as held for sale. So that's it. I have covered all the illustration. See you in the next part with all your test you understand in part 3. Till then, take care and don't forget to subscribe to my channel.